The cash flow statement is another important financial statement which looks at the money coming in and going out of a business. I'm Thomas Harwood and welcome to the Accounting Student, where we create free and short videos so that you can learn about accounting. Today's video is looking at the cash flow statement. As mentioned in the video on the balance sheet shows a business's financial position at a particular date and typically is prepared once a year. Although the balance sheet provides a cash value at a certain date, it does not show how the business has used the cash and bank reserves during the period. The cash flow statement uses information from the accounting records such as the income statement and balance sheet and shows the money flowing in and out of a business. In simpler terms, it shows where the cash has come from and where the cash has gone to. Furthermore, the cash flow statement explains the reason for the changes in the cash and bank balances between the periods and focuses on the liquidity of the business and clarifies in some cases why the cash and bank balances may have fallen despite profits being earned. It is important to note that profit is not the same as cash flow, and sometimes when good profits are made, a business can still experience cash flow difficulties. Similarly, a business can be reasonably liquid despite making only small profits. This can be caused due to a variety of factors. A few of these factors are large drawings being taken, large values of equipment being purchased, or generous credit terms given to debtors. The cash flow statement is very important, such to an extent that the accounting standards require all but small businesses to include the cash flow statement alongside the income statement and balance sheet. Let's have a look at the layout of the cash flow statement by looking at an example. At the top we have the title as a cash flow statement for ABC Limited for year ending 31st of December 2017. The cash flow statements are divided into the following sections. The first section is the net cash flows from operating activities. As you can probably tell from the title, this is the amount of cash flow generated from the trading or operating activities of the business. The second section is the net cash flow from investing activities. This section of the cash flow statement shows the cash flows relating to the interest received and interest paid. The third section is the taxation. The taxation section shows the taxation amount paid during the year, otherwise identified as the tax that was owing at the end of the previous year. Capital expenditure. This section shows the cash flows relating to the purchases and sales of fixed assets. For example, this may be the purchase or sale of tangible fixed assets, or purchase or sale of investments. Equity dividends. The next section looks at the payment of dividends. The dividends paid will be any interim dividends paid during the year plus any other dividends owing from the previous year. The final section is a financing section which shows the cash flows in respect of shares, loans and bonds. Cash inflows can be due to an increase in share capital from issuing extra shares or an increase in medium and long-term loans. Cash outflows can be caused from the repayment or redemption of share capital or by repayment of medium and long-term loans. The subtotals from these main sections are totaled to give the increase or decrease in cash and bank reserves for the year. This number should then reconcile to the cash and bank amount stated on the balance sheet. So that was the explanation of the cash flow statement. If you enjoyed it, press the like button. If you have a question you want answered, leave it in the comments below and we'll try our best to answer it. And if you're not already subscribed, make sure you click the red subscribe button to keep updated with the Accounting Student. Thanks for watching, we'll see you next time.